Good morning. Welcome to the Traders Workshop. We are wrapping up 2024, getting near the end, folks. Here we come. So today, Mark and I are going to talk about streakiness and hit rates with option trading strategies. So stay tuned for this interesting conversation about that after the bell. What? I like it.
I really like this.
This is Yellowstone.
Never watched that show.
Well, so I just watched, I record it. So I just watched the last 2 episodes last night of Yellowstone, one of my favorite shows. I miss Kevin Costner in it, but whatever. You know, it was really good.
Are you kind of going for that Montana Rockies vibe?
Yeah, I consider myself a Midwestern cowboy. Okay. And I should have been a cowboy, ode to Toby Keith, sort of. But my family says, but you don't like horses. I'm like, well, I don't dislike horses. I just don't want to be around them that much. And they'd be like, well, that'd be tough to be a cowboy, wouldn't it? I go, well, maybe, I could be a cowboy without being on the horse. What do you think?
Yeah, I just think Mom always told me to don't let your boys grow up to be cowboys.
Yeah, that's a good point.
That's what Merle Haggard told me. So
yeah, I know. They had 880,000 acres of land in Montana. Unbelievable. Not in reality, but in the show. That's a lot, I think.
I believe the producer is a big landowner out there in Wyoming or Montana.
He might be. It's beautiful out there. Anywho, well, good morning to you. No Jason today. He's protesting, right? And he's protesting because, I don't know, some news is coming out that we're going to miss, and, because we're taping and not live, blah, blah, blah. But, we're going to move along without him. What do you think?
I think he's just too busy with the year-end stuff. He just is overwhelmed by all the year-end wrap-up that he has to do.
I get it. So let's first, before we get to the streakiness part, back in the market maker days for you and me, anything interesting about the end of the year for us? And where I'm going with this question, I'll give you a hint, is, your final P&L is, indicative of your tax liability, if you know what I'm saying.
Oh, I was hoping you were going to go here. I was hoping we were going to do a little history lesson.
Okay. Now, we don't want to say there's anything illegal going on here. There wasn't.
Well, the rules allowed for, there was a big change in the late 80s that stopped this whole game.
Okay, let's lay it up then. What the hell? It's not like, it's, what's the word? It's beyond the statute of limitations.
Oh, far beyond. And this was legitimate business. It was a legitimate liquidity providing service that was, let's call it a tax loophole. That's what it was.
Okay.
And so there was a lot of flow that would essentially trade year end to mark losses, roll forward gains, various position adjustments that incurred different tax liabilities.
Right.
And market makers were there and able to facilitate that.
That's right. So in layman's terms, what Mark means is that he and I and our firms had big positions. And the way the mark-to-market worked is, and again, I'm drawing a little bit of a blank, but was it last trade back in the day? And did it go to midpoint? I forget.
I believe it's midpoint now. I don't know if it was ever last trade.
At some point it was. I know that. I don't know if it ever changed. But nevertheless, markets could change toward the end of the year or at the end of the year so that your positions would make or lose lots of money on that last trading day, in which case, whatever that net lick value was due to the marks on the last day of the year, that would be your basis for your tax liability in the coming year. Did I say that right?
I think so.
Okay.
I think, and even maybe in more layman's terms, if you had a big win one year and you didn't want to pay taxes on it, you could create a loss that would just roll that forward essentially.
And you could do that perpetually, sort of. I mean, maybe you get a little snapped up
there's some friction to it, of course, and there's the vig that the liquidity provider on the other side is going to take for doing that position.
Right.
But in exchange for, and I mean, this comes, sort of one of the main reasons index options are still great is that was one of the big trade-offs is getting 60-40 treatment on mark to market. So they made you mark everything to market at the end of the year, and you're going to pay taxes on, those positions on your 1256 contracts, but you get the 60-40.
And 6, just so people understand what that means. What is the 60-40?
That gains are payable and due in that year in Section 1256 contracts, options, index options, and or broadly, more broadly interpreted for dealers. Mm-hmm. But any gains are taxed at 60 at a blended long-term, short-term rate, so 60% long, 40% short.
Right. So 40% short, that difference is huge because the difference between, let's say on that, 35% was probably what we mostly were paying, right? I'm guessing on the short term, and the long term varies depending on who the president is, but let's say it's 23-ish, give or take 24.
Yeah, it's a fair split. Oh yeah. It could be a 10-point difference that you pay on.
Yeah. And if you're talking lots of money, that 10-point difference is significant. I mean, that's a big number.
Yeah.
That's a really good vacation.
Oh yeah.
Or maybe a car.
Well, it depends how good your vacations are.
Or how good your 10% is.
Exactly. No, I mean, it's huge. And listen, I think is that regime's very beneficial to investors and encourages people to use these products, right?
Yep.
To provide that favorable treatment for a risk mitigation tool. I think that's, a good and strong incentive.
Yeah. Did I tell you that you look fantastic on the camera today?
I've been playing with my lighting, my background. I've been getting advice from all kinds of kind people like yourself.
The distance here is awesome now. That looks terrific. You're centered in the thing. I see you don't have any glass behind you now. You've got the Folds of Honor flag back there among some other things I can't totally see, but perfect. You're a pro rock star now. I must add.
It's tough with the 4K camera, though. I got to spend a little more time cleaning myself up in the morning.
Right.
I can't just roll out of bed and get onto the show.
That's right. That's why I wear a hat, because this would be a problem.
in all 4,000 pixel.
Yeah.
Or whatever.
So my red hat is for Christmas. Yeah.
Okay.
I have a green one on. I have a green one on.
Week away.
Yeah, I changed my lights on my house to green and red. I can change that with my phone, which is pretty cool. I didn't know I could do that, but I did. Nevertheless, we should get to something important. So let's get to the streakiness and hit rates, okay? Because this is interesting as well, and I'll throw in some gambling, casino sort of lore as well. So, what do you mean by this when we talk about streakiness and option strategies and hit rates? What does that mean to the retail trader? Because that's who we sort of appeal to. I hope.
Absolutely. And I think it's actually the reason I've been doing a little bit of a dive in that is because of one of my retail strategies. And so, as we've talked about, I work with some of our mutual friends over at Peakbot and use their daily iron condor bot to put on, a short condor pretty much every day, varying sizes. Maybe some days we turn off, FOMC, we go light, that kind of thing.
Sure.
But overall, this type of trade is flipping a coin every day. You've got roughly a hit rate that you can analyze over time. You've got, your gains and losses are defined every day by the width of your spread and the, credit that you take in.
Mm-hmm.
So this strategy, you're going every single day on that, and it gives you a lot of these instances. So I've noticed that there's quite a bit of streakiness to this. I might be able to say that over time, this has a 65% win rate, but that 65% win rate can be an 85 win percent rate in some months. And it can be a 45 win percent rate or win rate percent in other months.
Okay. So the streakiness part is streaky good is the 85%. Streaky bad, obviously, is the other side, right? And that's natural in anything, right? Even flipping coins, even playing craps, playing blackjack. We've all seen it, right? We know what the odds are or the probabilities are in any of those casino games. And you can even get probability of profit in options too. Doesn't mean you're going to hit that in any sort of cycle. So all those events, especially flipping coins, there's, you're going to be 50-50 flipping a true coin, right, over time. But you might not be that way for 10 flips or 20 or 100 flips for that matter. You might get 7 in a row out of 10 that are heads. That doesn't sound like 50% to me, right? Or 70 out of 100 even. You don't know. That's the streakiness part. But in the long run, you're going to sort of tend toward that true statistical probability. Is that all safe to say?
Very safe to say, although the one caveat, and this was an interesting little thing that I learned when I was doing some research about this, is that the odds of flipping a coin are not exactly 50-50.
Oh, shit. Why not?
And I'm sure you've heard a couple of variations that maybe, like, depending on the coin you choose, the amount of, metal that's on the head side might be weightier, and so that causes it to fall down. This isn't that. This is that there's a slightly higher probability, almost as high as it's 50.8%. Of the coin landing on the same side.
Why?
So there's a same side bias to the flip.
Okay. I don't understand that. I don't think.
You're getting way above my head into, fluid dynamics and physics and, why things spin the way they do.
But are you saying then that it's because of the weight of the head versus the tail? Is that what you're saying? Or
no, it's not related to that. That's a common, I think, theory about bias in coins.
Okay.
But so this is that if, you have it face up heads and you flip it, it's slightly more likely to land heads, and same vice versa. If you have it tails face up, it's slightly more likely to land tails.
It doesn't make sense to me, but okay. I'm not saying you're wrong. I don't understand it.
I'll send you the paper. There are a bunch of Dutch guys.
I get it. I'm trying to think of it from a logic standpoint, how that could be, because, technically in statistics, they teach you that is an independent toss, right? And then what if I take the coin after its heads and I turn it over in my hand and move it around up and down and then flip it?
I think this more has to do with the motion dynamics of a coin flipping. Like if you take a random variable at 0.5 and set it to, be 0.5, it will be statistically, random around 0.5.
Right.
It's just specifically a coin.
Okay.
And the way it's flipped has that bias.
Got it. I've certainly been on good streaks at the craps table. I was just in Vegas last week. And I had my moments. I mean, if you can let me roll dice for, I'd say up to 7 minutes to 10 without crapping out, I just freaking clean up.
Well, that's the beauty of, and that's where you get into the gambler's fallacy. And that's why these casinos do so well, because everyone just gets the energy that builds. You're on a 5-7 minute streak. Everyone's making money. There's that energy is unbeatable, and everyone sizes up. It's,
right. But can I say though, and I want you to refute this, there's no such thing as tables getting hot statistically. It's just random luck that the sevens aren't coming up, because statistically they should come up more than any other roll on the dice.
Oh yeah, exactly.
I would say, I love playing at a hot table. I go, how do you know when it's hot? It's part of the streakiness concept.
That's why it's hard. And from a trading standpoint, that's why trading strategies, there are trading strategies where you're putting on a covered call, or you're putting on, a hedged equity, and
right.
You don't think about hit rate with something like that quite so much. Maybe short-term cover calls, whatever. But something like a daily condor trade looks a lot more, you're a lot more likely to exhibit that streakiness, or I should say, feel that streakiness.
Right. That's a good point. So let's go back to the trading world now. Now you're into your short iron condor. And I've noticed this, especially with zero DTEs in SPX. There is certainly streakiness, and sometimes I want to quit because for whatever reason, every time I put it on, it runs through my strikes for some reason. And I'm being facetious a little bit and dramatic because it's not every time, but it feels like it. So how do you deal with that streakiness, especially on the negative side? The positive side is easy to deal with. You think you're a rock star and you just keep collecting money. What do you do on the negative side when you're just getting breached all the time? You're losing. Maybe your strategy is to lose full value because you have a 25 delta on the short call and put, which technically means 75% of the time we should win on that. Technically, not exactly, right? So what do you think about all that? Break that down.
It's really tough. That's the psychological kind of grind of trading and trading a strategy. And I think kind of the best thing you can do, and that's why I'm digging into this so much, because I'm working with individuals that are trading this strategy and want to describe what the outcomes are going to look like. And, you've got to arm yourself with data. You've got to be confident in your edge and that like your persistence of that edge. Always kind of be asking yourself maybe what changed. But I think your bias has to be to, in this case, I'd say keep calm and condor on. But you've always got to be asking yourself, has something changed? But knowing what those streaks look like, I think are likely to be, over the course of a year, even if you have a 70% hit rate, the chances of you losing 5 times in a row are going to happen 2.5 times a year. Yeah, so like twice a year, like more often than you go to the dentist, you're going to have a 5 in a row losing streak on something that you have 70% odds of winning on.
Right. And that's
a great win rate, right?
It's a great win rate, right? And that shouldn't, dissuade you from doing the strategy, right? I mean, by any means.
No, not at all. I think you just have to know what your expectation of that pattern is going to be and size appropriately. Sure. That, you can't be betting 100% of the account on something that has any percent of a fail rate. Obviously this is where we get into the sizing criteria, Kelly criterion, whatever. But even just fundamentally, it's simple. Hey, like I know this is going to fail 8 times in a row or 6 times in a row or 4 times in a row, twice a year.
Yep.
Have that loss amount, and more in your margin account.
Sure. Any sort of advice you can give to someone who's doing this on his or her own as to, how to choose those strikes technically, or is there something you love more than other things that you can discuss without giving away secret sauce? And
yeah, I mean, the secret sauce is the 27.2 delta. And if it hits that, full account, full port mode. No, but seriously, I do like that 30 delta area.
Yep.
And that gives you, if you're selling a condor at the 30 delta area, that's 30% chances of it, or 70% chances of it not touching. You're roughly going to come up with a pure 50% win rate, 49 or whatever. Because of VRP, because of path dependency, we look at backtests and it's actually quite a bit higher than that. Because we expect the ball is going to be slightly overpriced and the 30 delta isn't 30 delta. It's really 27 theoretically or something like that.
Yep.
So yeah, like I said, I like going for that 30 delta area. Honestly, any strategy, I really like the 30 delta.
Yeah, me too.
Do you let active management too? I think it's important.
Do you say active management? Sorry.
Correct. You got, having a stop loss on something like this, especially with the short term, there can be a decent, you wake up in the morning, you're in the money, but that, you still have value on that condor or non-value on it, even if you're fully in the money.
Okay. So
that could be a good stop loss.
Right. So let's talk about this real quick so just people understand. So when you do these 30 delta short iron condors, right, you're collecting some amount of credit, whatever that might be. I think I'm hearing that you probably don't let this go to term and let the chips fall where they fall. Either you make whatever the credit is or you lose the full amount. Is that safe to say, or am I missing it?
You can let them go to term. Especially if you're trading SPX, that's super easy because it obviously cash settles.
Right.
And there can be some funniness at expiration where you're giving up pennies around the market. So like, that's why I like having this in SPX if you're truly going to let it go to term.
Yep.
But I actually increasingly think that, some stop loss can be warranted here.
Okay.
That if, you say 100 or 200% stop loss, that's going to save you in the scenario where, you've got this on and we just start moving immediately and blow through your strikes.
Mm-hmm.
Both your strikes might be in the money. So if we expire, then that's going to decay and be worth, the full spread.
Yep.
But because there's time on the clock, a $1 spread might only be worth 60 cents or $5 spread might only be worth $3.50, even if it's fully in the money.
Mm-hmm.
So that can be a stop loss scenario that I like with this strategy.
Okay. Interesting. So let me ask another question then. Time and expiration matter. So are you doing these 0 DTE? Are you buying a day, 2 days, 3 days, 4 days, all the above sort of scenario? And does it matter where your stop and profit targets are based on time? So obviously, the longer out we go, if you're getting 70% of max profit, 80% of max profit, and you've got days to go, does it make sense to take it off at some percent of max profit or not?
I'm finding I prefer the very short dated condors. And there I have like a relatively strict stop loss. On a longer term, I think, especially in indices, you start to get into a delta bias. And so that becomes kind of something to manage. And, it's easier to model the short dated ones because they look closer to that sort of like coin flip or, biased coin flip model.
So it could be a smattering of every, you could have some 0 DTs, a couple ones, a couple twos, a couple, it could be, you could kind of move them all over the place and have simultaneous ones on depending on value and that sort of thing.
And 0 DTs are hard because of pattern day trading rules.
Guess what? Finner's asking for comment. Geez, did you just say that? Oh my God.
How did that come up?
Yeah, interesting. My prediction, we're going to do a whole show on PDT coming up, but I think the rule's going to change. I'm feeling good about it. I'm hopeful.
Have you read some of the comment letters that are out there?
I haven't yet, but I'm thinking about writing one myself. I know you are as well.
I've got about 1,500 words right now.
What's the max words?
Many of them are very, very short.
Okay.
Many of them, yeah. But it's great.
Did anyone ever use the word stupid in their response?
I have some harshly worded words. I call the rules arbitrary and redundant, which I guess is as close to stupid as you can get for a regulator.
I love it. Okay, well, I want to do a whole show on that one. That's an interesting topic to me, and we can talk about the history of that too. We can go back in time and when that kind of came about and why and how silly it is. But anyway.
In all seriousness, though, the comment process is great because you have retail traders that are writing in. You have brokerage representatives. Right. Like you have another financial advisor. I'm a financial advisor. It's important.
Yeah, absolutely. I think exchanges. I think some of the exchanges are going to have their legal write something as well.
Yeah. Anyone that is watching this can write something. That's exactly who. They actually give a big list of 18 or 19 questions that they have, and not every participant's able to answer every single one.
Right.
Or comment, authoritatively on every single one, but they want to hear from market participants, and that's everyone listening here.
Right, for sure. Okay, last thing, let's close it up here. Just summarizing the streakiness real quick. So first of all, it sounds like don't let it frustrate you on the negative side because it's a likely occurrence, or not likely. It can be an occurrence. So you can't let that get to you a little bit. You have to be disciplined. Have an exit, have an exit burst on the stop loss side and on the profit side to some degree. And if your exit is let it go, that's what it is. Mm-hmm. But don't get caught up in streakiness and hit rates. Understand what they are. What else?
No, I think like the number one thing, and this is true of any strategy, but like know what you're getting into here. And if you're going to, be executing a short-term trading strategy or a long-term trading strategy, have your expectations set on how often you can lose, not how often you can win, not how big the returns are going to be, but make sure you also know how often and how severe and how streaky, those losses are going to be because they're inevitable. Right. And if anyone can find me a strategy that doesn't have that, I know a lot of people that would be interested.
Yeah, that's right. Okay, good. marksharvestedfinancial.com, right?
That's correct.
Anything new about you and what's going on over there? You want to give a little plug anywhere else here?
I've been teasing a little bit about this, but a lot of this work is because of the new partnership I have with Peakbot and the Peakbot portfolios that I'm managing here that are a portfolio, a collection of allocations to short-term trading bots. So, a lot of that is in iron condors, a lot of, the strategies driven by that, but we also do a wheel strategy and then a trend spread strategy too. So if you're interested in learning about that, definitely check out my website at harvestedfinancial.com and you'll find all the details about that. The till.substack.com is also where I write about this.
Let me give you a plug. I love his articles. I love your vocabulary too. Were you an English major at all?
No, I wrote for my newspaper though, my college newspaper.
That's it. I was an English major, so I love this, all the all the words. So it's terrific. His articles are great. The Till is terrific. You must subscribe. So I
dig into, like, my last one was about, this coin flip example. So
Yeah.
there are a lot more details about that if you're interested in that. Coming up soon, I will be posting my FINRA comment letter in the Till. So everyone can read that there too.
I love it. I have a whole folder for Mark Phillips, the Till. Every time I get one, I read it and I put it in there in case I have to refer to it again.
Oh, thank you.
You're welcome. You're welcome. It's very good. It's actually excellent. Okay, great to see you. Merry Christmas. Happy New Year. I might see you before the New Year. I'm not sure yet. We'll probably not, but we'll probably have reruns in the holiday season. But great to see you. Good luck with the Peacock thing. Keep us posted on that. What else? Am I missing anything?
Happy trading.
Well,
happy holidays. Merry
trading.
Christmas. Happy trading.
Yeah, be careful in the thin times of holidays. You never know what goes on, man. The people are on vacation, so watch yourselves, right?
And if you can, you should take a vacation too. That's my financial advice.
I love vacations. All right, Mark. Good to see you, man. Have a great holiday.
Take care.
Bye now.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.